before we start, if you're interested in Bitcoin and blockchain, please consider clicking that subscribe button and also click the bell so you can get notifications about future videos that I might post. Thank you. Hello and welcome to the Miko Bits show, and I am your host, Miko Bits. Today I have an exciting guest for you, which is Tom Howard, who is running a company called Mosendo. And this is a pretty exciting company and an exciting space called DeFi. But before we get into that, this video program is opinion only, and it's for information and entertainment purposes only. So it is not intended to be investment advice. So seek a duly licensed professional for investment advice. So what is DeFi? So DeFi is Decentralized Finance. And DeFi is very exciting because it's largely a way for people to do things using so-called smart contracts. And it sounds pretty fancy, but really the way that people describe it in the industry is money Legos. So if you put those Lego bricks together, you can build castles, you can build anything you want with Legos. And these are money Legos. So today on our show, we're going to be talking to Tom Howard and really getting a stronger feeling of how we can begin to play money Legos, which I think is an exciting prospect. So without further ado, let's bring Tom Howard. So Tom, please introduce yourself and let us know, a little bit about you and your background.
Hey Miko, good to be here.
Yeah, great.
As you said, I'm Tom Howard from Mosendo, and so with Mosendo, we built a stablecoin wallet that kind of earns interest from the DeFi ecosystem. So anytime, think of it like a Venmo or a PayPal. Anytime you're holding a balance in there, it's automatically earning interest from the DeFi ecosystem.
Great.
And we make it really easy for people to do that. They don't have to understand, seed phrases and MetaMask and all of that. You actually just sign up with your email and you're good to go.
Fantastic.
Yeah.
So what I understand that you've been actually holding workshops and you've actually been teaching people how to kind of get started with this whole DeFi thing, with this money Legos game, right? So I guess, what I'd love to understand from you is sort of what are the easiest ways for people to start to play? Because I think that concept of, if it is money Legos, then it's a game that we should play, right? It's fun. So what's the best way, and what are the best places to start, and how do we get into this game?
So just like regular Legos, there's the things that you can build that are really simple, and then there's the things you can build that are super complex and advanced, right?
Yeah.
And so don't try to build the Millennium Falcon on your first go at Legos, right?
I like that. Well, that's great. So tell me, what's a great starting point? I mean, obviously Mosendo is a great place to go and you can play that, but are there other places that really would be a great beginner spot to kind of start to learn about DeFi and start to learn how does it work, and maybe even shuffle some small amounts around just to kind of get the feeling?
Yeah, absolutely. So we have a great community called DeFiination, and so
Great.
we kind of have it. It's kind of beginner to intermediate focused content, and so about 14 months ago, I was in New York and met all these awesome DeFi founders working on super cool things, and nobody had ever heard of them. So we were like, hey, we should actually get these founders on, interview them, bring them into the community, let people know what they're up to. And so that community has been growing, and it's all just educational content. So
I love that.
A really great place to go. Join DeFiination.com. We have a Telegram and a Facebook group.
Great. So I'm gonna put that URL in the description below. So please feel free to kind of connect to that. I think DeFiination, the Facebook group, the Telegram group, and obviously you want to go to the website and check out those instructional videos. So I think that's really great. But for folks that are really just getting started, I guess what is a great way to kind of like get your first taste of this stuff, So let's talk kind of beginner land here. Like how do you get your feet wet?
Yeah. So, if they're money Legos, then you have a bunch of different types of Legos. And so we call them primitives.
Yep.
They're DeFi primitives. And so one of the first primitives that we have is the stablecoin primitive. So you need to get your hands on a stablecoin, which is, normally US dollars. So it might be USDC, which is from Coinbase.
Yep.
Or it might be DAI, which is the more decentralized version
from Maker.
From MakerDAO, yeah. And so if you already have ETH, you can actually deposit some ETH collateral and generate DAI from that ETH collateral. So that would probably be, kind of the first step. And they have a portal for that, the Oasis app, where you can very easily deposit your ETH and generate some DAI. Then you'll have your first stablecoin.
Got it.
That's
so
kind of like the very first step.
So tell me about this Oasis app. Like, where do you find it, and like what's how do you do it?
Yeah. So it's I think it's just oasis.app. Yeah.
Okay. Oasis.app. We'll put that in the description as well down below this video.
And so that's managed by the Maker Foundation. And so that's the official portal for interacting with MakerDAO.
Fantastic. So, so you can actually use sort of a web-based interface. So if you're using that, like, what are the minimum requirements? Is this like a MetaMask integrated? Is that the minimum requirement?
Yes, MetaMask or any Web3 provider.
Got it. Makes sense. So, I think that's another link and resource that we should provide is, we should definitely let people know that, MetaMask is a browser integrated Ethereum wallet, and all you have to do is download the plugin and you can start to play a little bit on this game. Just a little cautionary note, which is, one of the ways you can potentially lose money is you can potentially lose money through hackers. So, it is important to be kind of careful with things like browser plugins. One of the things that's really, I think, a really important principle about this is, walk before you run, right? And don't run with scissors, so really, start with if we're going to play money Legos, you're actually playing, like ETH is money, right? So like, you're playing with money and you don't want to play with too much money at the beginning, because you might get hurt. And a couple things that can happen, obviously, one of the worst things is really getting hacked, right? So you got to be careful about that. So we'll put the official MetaMask URL down below, so you can kind of get some assurance, because obviously browser plugins can be scary. And, there's definitely hundreds of browser plugins that do bad things.
That's true. Yep. And in general, in smart contracts and in blockchain and cryptocurrency, usually the newer the technology is, the more likely it is to have bugs, right? And so the longer it goes without having any major incidents, then supposedly the safer it is, in a sense. And so something like MakerDAO, their contracts have been around for many years and been audited, and they're the big dogs in the industry. So they're relative to other newer projects safer than other ones. But of course, as with any code, you never know if there's a bug that nobody's figured out yet that could be exploited. So that something like that can happen at any time.
Yeah, absolutely. So, we did talk about kind of a browser plugin exploit. So that's a potential source of danger. Yeah. But one of the other things that you were talking about is really paying attention to the maturity of any protocol or any service or any app that you're using, any smart contract that you're using, because obviously the older it is, the more it's been battle tested, right? Because obviously hackers really want to get the rewards of draining these smart contracts, because there's, lots and lots of money at stake. And some people are playing really big Legos, and so I guess my question is this, right? Which is what we know that, MakerDAO actually had a problem, and that was kind of I think it was Black Thursday or something like that for DeFi. And so I'd
That's right.
love for you to kind of comment a little bit about that, and like, should we be worried about something like that happening again?
So yeah, there was a confluence of events that each on their own would have caused no issues at all, but when they all happened at the same time, it caused a bunch of problems. The good news is that the MakerDAO system fail safes worked as they were meant to, and so we had this issue where you have your collateral, which was not able to cover the debts, which is your stable token that's
Yep.
generated.
Yep.
The collateral value was dropping so fast that it went underneath what the stable token was worth, and so you had a system-wide deficit of about $4 million. And that sounds like pretty scary, but actually the purpose of the MKR token is to resolve situations just like this, where if somehow things end up a little bit crazy and there's a deficit, what happens is the MKR token has an auction. They sell off the token to cover that deficit, and so all the MKR holders get diluted in order to do that. So they're incentivized to maintain the system in such a way that that shouldn't happen. But in case it does, there's always that backstop to resolve the situation.
That's very
And so
interesting. So sorry, go ahead.
yeah, so that's exactly what happened. They auctioned off MKR. People were bidding on it. It was a whole big thing. They covered the $4 million deficit, and now the MKR system is in the green again.
Yeah, yeah. And what here's what I understand is, that there were people that were DDoSing the Oracle and kind of creating this sort of lag, right? So one of the things that's really effective is that if you can even have a price that is lagged, then you can potentially create like an arbitrage loop, or you can create a loop where you're buying things cheaply and selling them, for more. And so, this is definitely like stuff that can happen out there.
Yep, that actually was a benefit to the entire system because the price was dropping so fast.
Yeah.
So you have like each lender, they're like separate kind of vaults, and so if your personal vault goes underneath the collateralization requirement, then it goes up for liquidation, and liquidation's an auction, so it's not based on the Oracle. So the Oracle getting stuck at a higher price for several hours actually saved many vaults from being liquidated because the price bounced back up, within an hour or two, and so it actually helps reduce kind of the deficit that would have happened in the system
Got it. So
if
the
that wasn't
system
DDoSed.
has certain amount of kind of metastability based on this kind of like tendency to reestablish norms, right? So,
Yep.
that
Yep.
that's important. So, I guess one of the things that's very interesting, obviously, is that people have really kind of pushed heavily into the Maker ecosystem and are using DAI and are kind of getting all this kind of value out of that. But I think that we would be remiss if we weren't talking also about Compound, which is sort of the new kid on the block, and it's becoming
right.
kind of exceedingly and kind of ragingly popular. And I think one of the things that's super important to talk about are C tokens, right? Because C tokens
Yes.
are kind of a fundamental innovation in DeFi, and it kind of unlocks the power of things that were formerly locked. So please, maybe you can. I think what we should do is take a step back and just talk about what contract locked ether means, and how does that work from the perspective of borrowing and lending. Let's just spend a very short amount of time on that, and then we can move on to kind of helping people understand what's happened with Compound and what makes Compound special.
Yeah. And so I guess what you're getting at there is when you're putting ETH into the Maker system, that ETH is stuck in that vault. You can't do anything with it because it's collateral, right?
Yep.
And so you get the DAI, and you can go and spend that DAI and do whatever you want with it. But that ETH is stuck there until you come and repay your debt. So it is locked in a smart contract. And one of the fundamental innovations of Compound. So Compound is also a lending market, but they have more assets than Maker does. So a variety of stable coins and other assets that you can lend or borrow. But what they've done is they've created these C tokens. So if you're depositing DAI, which you want to lend against, you deposit it in there, and then you get C DAI, which is a C token. And
Yep.
so this is a tokenized collateral position that's always earning interest and it's always accruing value. But you can actually go ahead and send that around, so you don't have to keep your collateral there. You can send it to anyone or anywhere because it's another token. Uh, so, and then in compound, if you're just depositing and you're earning interest, you can send it around. But if you want to borrow from compound, then that's when your C tokens get locked into compound. So if you're putting in C DAI and you want to borrow ETH, then you'll have a bunch of ETH that you can do something with. But whatever that value is that you borrowed in ETH, you'll need to keep a bit more than that locked up in the C DAI.
Yeah. So like, so this is big, and just to kind of, for the newbies, like I think what's important to understand is that in a compound ecosystem, what you end up with is let's say you put ETH into a smart contract, like you're gonna get CETH, right? You're gonna get like a token, and you're gonna get a tradable tokenized representation of your collateral, right? And so now it's actually something that is an innovation, right? And it's an innovation that provides additional value than just locking them in, because if you lock your collateral, it stays locked until you pay back the loan, right? And when you pay it back, you can kind of get your principal back, right? That's the general idea. So the question that I would have though is, isn't all of this kind of causing the creation of a kind of potentially large debt bubble?
A debt bubble? I don't think I wouldn't call it a debt bubble. Right now, the entire system is pretty heavily over collateralized. And so if you compare that with the traditional finance system, everything is heavily under collateralized. So you have, well, before banks could have, what was it? I think 250 times. The fractional reserve banking was hey, if you've got some deposits in your bank, you can lend out 250 times that amount. So it's like 250 times leverage.
Yep.
And they've actually just eliminated that requirement. So now you don't even need to have any assets in your account because the Fed's got your back if something goes wrong.
Yeah, one of the fascinating things that I think people really think is very meaningful about the system is that DeFi has like automated liquidation, right? So
Yes.
the automation in the liquidation actually produces like an incredible amount of kind of robustness in the overall system, right? Because things there's no zombies, right? Like a zombie is sort of a situation where someone is dead, but you can't collect, right? Because if you look at what happened in kind of this leveraged debt bubble in 2008, that took down Lehman Brothers with this CDO type of product with these kind of like mortgage-backed securities, is that what you had zombies, right? You had zombies, which is basically you had debts that they were just dead. They were defaulted, and ultimately what happens is that the bank kind of has to foreclose on the property, and then they kind of have to liquidate the property, and they have to, like, it's just this really, really big, deep, horrible mess. It's like a big pit. And the thing that's interesting about the collateralization, on the blockchain is that you have automated and instantaneous liquidation, which produces a bit of, a bit more strength. It's a little bit more resilient. I guess my question to you about these contracts, though, is how do you keep yourself from being liquidated if you're a borrower? So if you want to borrow, and like, how do you prevent liquidation? Because at some point, like, maybe the system decides that you've defaulted and you get wiped out. So like what has that happened to you? And like how does that happen? It feels like the type of move that like every person playing with Bitcoin probably like ends up losing a key, maybe with a little bit of coins on it. So like people probably playing with money Legos end up getting liquidated, right?
Yep. Yeah, and I'd love to answer that question. I just want to circle back
Yes,
to the traditional system.
go ahead.
Uh, I think one of the you brought up a very interesting point, which is the watchtower effect. Anybody can come in and liquidate a position. So literally anyone, it's completely open, is watching and making sure that everything is working as it should. And if it's not, they can liquidate it and get a reward for doing so. So you have this big like watchtower effect.
Yeah.
The problem that we had with the global financial crisis was that everything, instead of being open and transparent, was opaque and hidden. And so you had these bad debts, which were being classified as good debts, and people were buying it. And it was almost, in a sense, it was fraud. They were selling lemons in the market, right? And so that was really the major issue. Derivatives and lending is not necessarily a bad thing, but we have to structure it in a way that's open and transparent and responsible.
That's
Um,
fantastic. So I love what you're saying, because to me, like, we're all kind of really strongly hoping that we can build kind of an alternative financial infrastructure, and one that has kind of intrinsically different properties. And I think one of the properties that you're pointing to that I think is so essential to the definition of DeFi is transparency, right? And so what
yeah,
you're saying is and the other one which we touched on earlier is obviously automatic liquidation, right? Which is kind of this notion of preserving the liquidity, right? Because obviously if you have bad debt that just piles up, like zombie debts they're just never going to collect those. Like, it's over, right? It's over.
yeah,
But the thing that's crazy about zombies is that, like, the zombie is their life is over, but the zombie doesn't realize it. Right? The zombie just keeps eating brains, and that's
yes,
what happened to Lehman Brothers. $600
that's right.
billion of balance sheet, in a day, effectively, right? So really,
Yep.
really brutal liquidation, and obviously firms like AIG that insured those positions, like AIG was liquidated, right? And so the dominoes were just all over the economy. And, that was the end. Like, that was really the end of the normal financial system, and obviously there were some extraordinary interventions that took place. So tell me about kind of, so tell me about the most simple kinds of money making loops, or what are the simplest things you could do, right? So you said you should go over to Oasis app, like you should go over there, like stick some ether in a contract, get some DAI, like is that all it takes? Can you just hang out that way for forever? Like is that, like, what else can you do?
Yeah, so it depends a lot on what your goals are, and the size of capital that you have available. Uh, so if you're somebody who is holding ETH and wants to continue holding ETH, and going long on ETH, MakerDAO is a great system because it's basically giving you a very, very cheap form of leverage. You're putting up your ETH as collateral in the same way that you would put up your house as collateral for a mortgage, right?
Yep.
Uh, and you're getting this USD back. And what you can actually do with that USD is go buy more ETH.
Yeah.
And so your ETH can turn into 3 times more ETH.
Yes.
And if you think the value is going to continue to go up, then things are going to be gravy. The thing you have to watch out for, and this comes back to your earlier point about being careful about being liquidated, is that if you go leverage up 3 times on your ETH and the price starts going down, well, you're going to get liquidated if you don't have enough collateral in there, right? And so if the value of your ETH falls too far below the value of your debt in a certain ratio, then it'll start selling off your
Got
ETH.
it. Got it. So basically, like, as you kind of lever up your positions, the thing that's really interesting to kind of calculate, right, is sort of what are your expected thresholds, right? So it feels like the
That's right.
smart thing to do is maybe like crack open a really simple spreadsheet and maybe run a couple of scenarios, right? Like, be like, okay, well, what does this leverage look like at ETH at $200? What does it look like at ETH at $150? Like what does this look like? And how dark does it get, right? Because if it starts getting dark, like you may the idea is that you don't want to make a weak hand even weaker, right? Because what happens if you over leverage an already weak hand, it just means that when things get dark, like you just start getting liquidated, right? You're just going to start getting chopped, right? And so over leveraging, it becomes kind of dangerous. It becomes that becomes your mortal enemy. But I think that the thing that I'm excited about with this is that it creates a primary velocity of money in the Ethereum ecosystem, in the economy, and it creates therefore kind of a fundamental use case, right? So people are talking about like, oh well, what is it? What are we doing with these things? And like, we're building financial products. We're building money Legos. Yep. So that's a great use case. So what about so for example, one of the things that's interesting becomes like, how does it work in the case of Compound? Because like Compound, the thing that's really interesting is that you put your ETH in and then you get like CETH, right? So now you have that stuff. So like, what do you do with that, right? So, obviously that's a new kind of a Lego, right? It's like that's a little Lego man or a Lego, so what do you do with it?
Yeah. So I think another great use case, which is more approachable for most people, not everybody wants to speculate on the value of ETH. And so what you can do with Compound is actually you take stablecoin, which is a US dollar, and you lend it to Compound. And that can be all you do. And what you do there is you're basically earning interest for lending it to Compound. So you've got US dollar and you're earning, 2, 3, it's gone up to 12% on US dollar.
12% is bananas.
14 actually. Yeah.
That's super bananas.
So if you put that in your bank account, that same USD, you're going to earn like 0.01% in interest in your checking account, right?
Agree.
So right now you can get like 1 to 2% because things are very liquid and efficient right now, but the rates tend to fluctuate. So it does go higher than that. So that's probably the lowest risk, simple way that people can benefit from DeFi. And obviously, 2%, for that to be really appealing, you're going to want to put larger sums of money. If you put in $100 and earn 2% a year, you'll have to wait a year to get $2.
So let me talk to you about Comp though, right? Because Comp as a token, like what we know is that Comp is a governance token, right? So like technically speaking, it's sort of used to vote for, improvement protocols. And what we know is that as a governance token, as the launch of Comp as a sort of mainnet construct, it really means that the company, Compound Finance, is really actually no longer in charge of Compound, right? That the holders of Comp are now in charge of Comp, right? But so that's that. But like the thing that I understand is that participating in the Comp contracts actually rewards users in Comp, right? So, so one of the things that I discovered actually is that there's you can use something in InstaDApp. So that's another link that we're going to share down below. And in InstaDApp, you actually can use this little gadget, which is a Compound kind of yield farming mechanic, so you can actually interact with a contract that they've developed that actually helps you maximize your kind of Compound yield as a function of executing some smart contracts, and lending. So that's a fun little gadget, and that's something that you can play with, right? Because one of the fun things that is interesting to understand is that you don't have to build a Lego castle. You can actually go use someone else's castle that they already built, right? So that's fun. That's another fun thing to do with money Legos is that like if you want a castle and you want a little soldier inside, you can basically go grab someone else's castle that they already built and someone else's soldier, and you can put them together, right? So, that and InstaDApp is a cool resource for kind of playing with things that people have made, and in a way that I would say is less difficult than writing your own, but it's still a little bit more difficult than like using like a centralized interest bearing crypto service like Celsius. I mean, full disclosure, I'm a Celsius advisor, and centralized interest bearing crypto is probably the easiest because you don't actually have to have custody. You don't have to have things like MetaMask. You don't have to manage a private key. So there's a lot of things that, like, if you're a dead beginner, you might actually think about, looking at, solutions where there's interest. But maybe what's happening is that the provider is actually helping just deal with a lot of the hassles for you.
Yep. Yeah, that's right. And yeah, if you're looking just at maximizing your yields, then right now the centralized providers tend to have better yields for sure.
Yeah, it's interesting, right? I mean, obviously there's philosophical issues. Some people are very committed to decentralized, finance, and that they don't want to have, Satoshi Nakamoto said the majority of the benefits are lost when you reintroduce not reintroduce, but when you have a dependency on the need for trust of a third-party intermediary, right? So all of that is kind of like, yes, philosophically, we want to decentralize that, and we want to have permissionless, public, blockchain-based, obviously fully transparent by nature and governed by kind of a decentralized autonomous organization. So those are all philosophical issues, but obviously from a practical perspective, maybe you don't want to become a Lego master builder. Maybe you just want to collect more interest than your traditional bank offers. I think from the perspective of being cautionary, like, the thing that's important to understand though is that while these things provide interest, these smart contracts, they are different from traditional banks in one fundamental important sense, which is the insurance. Right, which is that unless you explicitly participate in an insured contract, which is a specific type of smart contract, which isn't particularly common in this ecosystem, you're going to be it's going to act more like a stock. And it's going to act more like maybe a higher risk stock, right? So it's not FDIC insured. So it's not like, the principal isn't guaranteed, right? Like, you can lose, and you can lose in ways that are just extraordinary. Like the whole ecosystem could implode. Hackers could find a way to drain a contract. So you lock money in a contract, and then hackers can be like, oh, you know what I figured out that I can withdraw from this contract using some really crazy way that no one invented. So I guess what I'm saying is that, like, the goal of this, especially if you're a beginner, is that you really want to play and you want to put small amounts at risk so that you don't get damaged by playing with, because these are money Legos, right? So, like, you got to play Legos.
Yeah, absolutely. I mean, I think kind of where we are right now reminds me of the early days of the personal computing. Back when Steve Jobs and Woz were at the Homebrew Computer Club with a bunch of nerds, and they're all tinkering and building their own PCs and, like, kind of putting all the pieces together to make a better PC.
I love it.
And then eventually, like, Steve Jobs is like, all right, we have all the ingredients here. How can we package this up and make it usable for the regular person? And then they went and started Apple, right?
Yeah. It used to be like a kit, right? Like a computer kit. Yeah. You can build it yourself. Yeah, I love it.
That's right. So we're in the kit phase, and the Macintosh is yet to come out, but
there's people attacking that, right? Like what about something like Argent?
Yeah, Argent is a great example where they're making it a lot easier. You don't have to deal with, like, gas fees and MetaMask and all of that. And so I do think that where the industry is going, like, right now you have the centralized providers, which provide a better experience. But I do think that the decentralized providers will, over time, be able to catch up to that experience and provide as good of or better experience than the centralized providers do today. This applies across the industry to exchanges, everything. Like, we have the technology to make that possible, and it takes, because it's decentralized, it takes more time to actually architect it, put it together the right way.
Yeah, I mean, I like your perspective on several counts. And I think one of the things that's really important for people to try to understand is I think it's important for people to understand the context of what is happening here, which is we're seeing the birth of a fundamentally new phenomenon in financial services. And the real core killer application here is this kind of interest and compounding interest, right? So obviously, like if you look at a token called compound finance, it's very clearly named after this principle that, there's an apocryphal story that Albert Einstein said that the most powerful force in the universe is compounding interest. He didn't actually say that. But the thing that's interesting is it became a meme because compounding interest is crazily powerful. And the idea that people can get annualized interest rates, I mean, I'm a little bit thinking that like 14% annualized compounding interest is maybe not a long-term sustainable thing. But the thing that's really interesting is that what you're saying is that you're saying that these are very well collateralized and sort of exceedingly transparent configurations of money, and so because of that we should kind of continue to express confidence in and the question would be this is, since it is transparent, are there any analytic sources that we can rely on that we can kind of see? Because what I do understand is that it's very clear on chain that we can understand what's the total number north of $1 billion stuck into these contracts, right? But what other, are there any analytic companies that we can rely on, or any sources or websites that we can look at to make sure that we're not going off the rails, right? That we can, are there any analysts that we can look at and that are sort of reliably kind of, for lack of a better word, watchdogging the DeFi industry to make sure that it's not Lehman Brothers?
Yeah. So the easiest one to get the overview is a website called DeFi Pulse.
DeFi Pulse. So is it DeFiPulse.com?
That's right. DeFiPulse.
Great. We're going to put that right in the links because, in order for us to get comfortable, we need to make sure that we're building a house of Legos and not a house of cards, right? We really want to make sure that all the bricks are locked together. And, obviously if you're building a really big Lego city, there's going to be parts of the city that'll fall down on their own. You're going to look over there and be like, oh, sorry about that, guys, or whatever. Because we are seeing that, right? We are seeing hackers draining contracts. We are seeing kind of like these Oracle DDoS attacks. Like we're seeing things where parts of the city they're kind of falling apart on their own, right? But the thing that we need as confidence is we need to have confidence in the amount of collateralization backing the amount of leverage. And we need to kind of understand that ratio of leverage, don't we?
Yes, absolutely. So I'm not aware of any project that gives you an overview of all of the different ones in one place.
Yeah.
But every project tends to have their own tracker. So if you go to the MakerDAO website, they've got an interface that shows the total kind of loan to value ratio for their system.
Great.
Compound has a similar one. And one thing I wanted to dig into earlier, you were saying like the liquidation is automatic. So the liquidation is, I would say, semi-automatic. It actually incentivizes other people to come and do the liquidation themselves. So if something's getting liquidated on Maker or on Compound, the smart contract is saying like, hey, this it's past the threshold for liquidation. You come in and like take care of this. Like anybody can come in and do it. So they've actually created an incentive of watchers to make sure that things are.
So tell me what you mean. What do you mean by someone can take care of it? Like what does that mean? Like let's come up with a scenario. Sure. So the scenario is let's say that there's Alice, right? And Alice has kind of locked one Ether, small amount, into a smart contract. And let's say Alice kind of goes on this bender and starts kind of like leveraging it and all of a sudden, let's say that like Alice is really in a tough spot, right? So what happens next? Like what are you talking? What does Bob do? Like, is there Alice, Bob, and is there even a Charlie? Like, what happens next to Alice?
Yeah. So what happens to Alice is that she's put in one ETH, and maybe it was $250 at the time she put it in,
Yep.
and then the value goes down, and it's now just worth $100. And so the system is saying, hey, you've got $150 in debt, and your collateral doesn't cover it.
Yeah.
Well, it won't be that because the collateral ratios are different. But let's say it goes down to 200, and she has 50 in debt.
Yeah.
It's gonna put it up for liquidation, and somebody comes along and says like, okay, I will pay I'll pay the $50 debt, but I want $70 worth of the ETH. And so you get this auction mechanism, and so anybody can come in and bid, and the best bid wins, right? So Alex might lose $70 worth of ETH, but that $50 worth of debt is paid off. Or somebody will do a much better bid, and she only loses $55 worth of ETH to pay off the $50.
That's interesting. So does that mean like, let's say that Bob comes along and kind of takes care of this debt,
Yep.
right? So like, does that mean that Alice now owes Bob money, or how does?
No.
So
She's given him. He's bought the ETH that she has as collateral.
Okay.
So she has less ETH, but she has no more debt.
Got it. So
normally the bank forecloses on your house because they can't split it up, right?
That's right.
So they take the whole house.
Yeah.
But this is like the bank just coming and taking your garage because you
I like
you owe them a bit
that.
of money, but not your whole house.
Oh, that's beautiful, right? That's really that's so valid, right? And obviously, like, it's a very important principle, and it's really a subset of what we were talking about in the context of automatic liquidation, right? Which is we're really talking about a system that has its resiliency, right? And it's designed around resiliency. But one of the things that I like to emphasize is that I'm a big student of complexity theory. And, for me, one of the things that's really important is that there's a researcher named Per Buck, and he is complexity researcher that he analyzes systems called self-organized criticalities. And essentially, it's the study of avalanches, right? And the thing that you can conclude if you study self-organized criticality is that these complex systems that have this kind of evolutionary feedback quality essentially start to model these criticalities. And what happens is that such systems are known to collapse. And if you actually study such systems, what happens is that you end up understanding there to be a perfect power law distribution of collapses of different sizes, so there being one really big collapse, and then you have more and more and more and more collapses of even smaller and smaller size, right? So, if someone defaults and they get liquidated, that's a small collapse depending on the size of the liquidation, right? And if you start seeing a cascading set of collapses, let's say the price of Ether drops to like $50, right? Then you're going to see a lot of liquidations, right, across the network. And the question becomes kind of how epic or how seismic are these things that are happening, right? But what I do want to explain is that just because it is decentralized and just because it is transparent does not guarantee that collapses will not occur, right? But the thing that's very interesting is that it enables there to be you can financialize the collapses in such a way that you can actually kind of, make it, you can make it actually lucrative for some people to come in when when the chips are coming down, right? Because everyone can see it happening. So that's so the idea is that you can potentially create more sort of meta stability. So that's, I realize that's kind of abstract, but I just wanted to kind of share that perspective on, the effect of transparency and the effect of kind of like openness on a system that, it makes it fundamentally unlike CDOs and, mortgage-backed securities and kind of the leveraged debt ecosystem that created the Lehman bubble.
That's right. Yep.
Well, that's good. This is all making me very kind of more optimistic. So are there other, so we mentioned InstaDApp, which is kind of a fun gadget. That's sort of like kind of a MetaMask dependent type of system. And, maybe Argent is something that's kind of not MetaMask dependent and maybe a little bit easier of a user interface. Are there other providers that you would point to? Mosendo is obviously like a really fun and easy to use system. Like what other providers would you say are kind of worth playing and maybe would be great for sort of beginners that aren't really trying to, get a PhD in this?
Yeah. Let's see. Yeah, it is still a little bit early days.
Got
So
it. I like that answer. The answer's great. It's so the answer's kind of like, it's not, there's no kind of like super easy.
Yeah, you can get pretty far on Instadap and Argent.
Yeah.
And the trade-off there is that you're limited to the things that they've kind of included in their interface.
Of course.
And they tend to include the things that have been around longer and are less risky.
Yeah, which is nice.
If you're looking for bigger returns and higher risk, then you got to dig into it, and you have to use the more complicated tools.
Yeah, but you got to start somewhere.
Yeah, and you have to understand the risks. So, there's things like balancer pools, which is a very new project they've just launched in the last few months, and a very good project, and it can be quite lucrative if you're doing their yield farming technique.
What is a balancer pool?
Balancer pool. So it's a system for enabling exchanging and swapping. So you have two assets in a pool, and then if you're providing the liquidity to that pool, you're just earning interest. But if you're just a user and wants to trade, you can swap from one asset to another with very low slippage and very low fees. And so the balancer pool enables this like multi-asset kind of pooling thing. So if you've heard of Uniswap
Yep.
was like the first one to do this kind of pool-based, they're called automated market makers.
Yep.
Swapping. But with Uniswap, you can only have one pair in a pool. With Balancer, you can have tons of pairs in a pool, and have lots of different pools, and they all get liquidity from each other. So it's a really cool system. It's very new. There was recently an incident where there was these tokens that modified the ERC20 standard, and they didn't work correctly with Balancer. And Balancer, said in their documentation, like, this should only work with, vanilla ERC20.
Yep.
If you're doing something else, it may not work right. And, lo and behold, like, it didn't work out right. And somebody came along and drained the pools. But it was kind of like, hey, they warned you guys that you shouldn't do that. Like, they told you if you mess with the standard, then it's not going to work as expected. And so that's kind of what happened.
Yeah, and to me, that's so interesting and a strong case study, and it's very important for people to understand, right? Which is that the thing that is kind of complicated about this is that when you look at the decentralized financial system, at the moment, the principle that governs such a system is actually code is law. That's the principle, right? And so if the code says something that's horribly wrong that results in someone losing all their money, like, that's quote unquote legal, right? Like, that's just what happened, right? So in a sense, like, we're still in the early stages, right? And in a way, the thing that you cautioned earlier about kind of walking on well-trodden paths, right? Like go on the places where others have gone. That feels a little bit safer, right? So it's the idea that you're going to cross a bridge that you see thousands of people crossing the same bridge, like, that might be safer for you than going somewhere really strange.
Yep, that's true. And then we have this whole like yield farming technique, and so that's the idea of earning interest from or earning incentives from compound, right?
Yep.
So you earn interest from compound by depositing and lending, and that's the normal money market. But then you have the incentives that they give, which is the comp token. And so this is where people are seeing the really high interest rates right now, like the 100 and something % interest rates. And that's because of the incentive. And so I like in this,
go ahead.
We've both lived in San Francisco, and I think, we've probably lived off of VC money, by getting all these like, rocket food and all these incentives like, Uber Eats coupons and all these,
This is a great metaphor.
free little like giveaways to try and incentivize users to come use the platform.
Yeah.
I've eaten many months for free just on like the VCs.
Yeah. I had a friend who was using a Postmates coupon hack to kind of get like almost infinite free food. That was pretty fun.
That's right. So now we're seeing, this was something that like, this just people in San Francisco were able to take advantage of in the past. And now we're seeing a similar effect in DeFi. But it's open up to everyone in the world.
Actually, there was a centralized finance hack around VC money, which was that a pizza shop actually learned that you could actually buy a $22 pizza from their own shop for $16. Right. And that this pizza shop actually started creating an arbitrage loop where they would start ordering their own pizzas and making essentially like whatever it was, like $6 or whatever each time they would buy their own pizzas, right? And obviously the thing that was so funny about that was that since they were the customer, they didn't actually need to fulfill. So they didn't actually need to make the pizzas. They would just go into this loop where they would order infinity pizzas, and they were shocked at how the vendor didn't close the loophole, even though they had delivery people showing up, and the delivery people would show up and be like, where's the pizza, and they would just be like, a customer decided they didn't want it or whatever, and then they would still
they delivered it to themselves.
Yeah, that's even better. You can actually use the same pizza.
just to make sure that there was nothing wrong. The dough was very cheap, so they actually just put the dough in the box.
But it's so funny. Right? Because if you imagine the experience of someone who's doing the delivery, right? Like the person doing the delivery is like, here's the box. I'm carrying the box, and they go outside the store and they're like, the delivery address is like, it just the head explodes. Like, what is happening? Yeah. So I agree with you. The thing that's amazing about what's happening with compound yield farming that actually is abnormal at the moment is actually that compound itself is a tradable asset, and that the price of compound on things like Coinbase Pro have been kind of trading up because people are like, oh, I'm excited about compound. So the rewards that initial users got in compound they just inflate in value, right? So it's just this very kind of weird bubble-ish kind of like scenario. And the thing that's so funny is that the rewards increase so much in value that there were scenarios where people were being paid in compound a pretty high yield for borrowing money. Right, which is so funny, right? So it's funny. It's like, I'm going to borrow money, and then the bank is going to pay me they're going to give me a bunch of toasters, or they're going to give me something. Something that I can resell. Actually, it's not even toasters. Like, they're going to give me money for free because I'm borrowing from them, that feels a little unsustainable. That feels like the pizzas sale thing.
It's definitely unsustainable, but they've just gone ahead and purchased the attention of a very large amount of people with this program. So, I think it's a good growth hack for them. Yeah, and the thing is, like, when you're putting money in that system, if you're lending out and earning comp, you're not going to lose your principal if the comp price goes down. Like, you're just the value of your bonus is
tokens.
Unknown, right? Yeah, they're bonus tokens, right?
Yeah.
They're like, the value of that is unknown. That could go to zero, but the value of your collateral is still the value of your collateral. That's not going to change if the price of the bonus tokens crashes.
Well, and
which is kind of the big departure from the 2017 ICO phase.
And
you lose your principal.
Yeah, and that's the thing that's really complex about this whole game, though, is that the ICO bubble was essentially an equity bubble, right? Whereas this, if you want to call DeFi a bubble, like, it's a debt bubble, and it's kind of a leveraged debt bubble, right? And in a sense, if you're an economist, like, in theory, you would be more worried about a leveraged debt bubble than you would be worried about an equity bubble, right? Because in a sense, so it's interesting. The good news is that most of the activity that people are doing is really just kind of in-house. Right, that they're really just circulating ether and
Yeah.
that's creating an Ethereum bona fide Ethereum economy. So I guess just to give you kind of a question to kind of wrap up with, one of the last kind of guests we had on our show was talking about the emergence of Ethereum 2.0 and staking, and how the staking rewards were going to compete with Ethereum 1.0 DeFi. So, what's your perspective on this kind of quote unquote competition? Because ultimately, those two reward mechanisms, compete
Yeah.
on the basis of yield, right? So, it's
That's right.
whichever one is going to be more fruitful, I think people will pursue. So how do you think that plays out?
I think everybody has a different risk appetite and they've got a different way that they construct their portfolio. So right now, the yields on ETH and DeFi are very, very low, approaching zero. So it's people are not lending ETH in order to get interest. They're using ETH as collateral for something.
Got it.
So from like a yield perspective, I don't think that ETH staking will compete because the yield staking is obviously going to be much better. Uh, what the DeFi systems might lose is this source of collateral. But I think what will happen is that we'll have basically tokenized, yield tokens. So you can actually stake your ETH and use it as collateral in a DeFi system. So I
Good
think that's where it's
times.
going to go, and
Good times. That's a beautiful
you'll get your
solution.
yield and have your collateral, no problem.
You'll have your cake and you'll eat it too.
That's right.
That's fascinating. Well, great. This has been, I think, a really fascinating show. Would love to kind of let you get in any final words. If you want to talk about DeFiination,
Yep.
anything that you'd like to say at this juncture, you're most welcome.
Sure, yeah. So if you want to learn about more about DeFi, we have a bunch of great videos and articles and conversations in DeFiination. So that's joindefination.com. You'll have the link to the Facebook and the Telegram there. And I tend to post about like interesting things that are happening in real time in the DeFi industry on my Twitter. And so that's @_Tom Howard on Twitter. So you can follow me
Fantastic.
there.
That's super helpful. Really, really appreciate your time today. It's been really fun.
Yep.
I feel like this. I feel like, maybe not homebrew computer club, but maybe I feel a little more like sort of 1992 and maybe like the birth of the internet, people building their own web pages using HTML, stuff like
Right.
that. So, because of that, my mood around this show is very much kind of like, let's play money Legos, so that's been the way
I
that,
agree.
I look at this. And, and if you're going to play, like, don't play with live ammunition, just play with small amounts and, just learn, right? Because I think
Yep.
you may learn really deep, valuable lessons, and those lessons may cost you a little pocket change, but, don't, and obviously there's kind of a, I don't know, there obviously may be sort of some minimum thresholds where it stops making sense, with respect to things like paying gas fees and whatnot. But like,
Yeah.
please go ahead and like enjoy. We will place a lot of cool resource links below, and you can begin playing money Legos. So
Yep.
that's really what it's all about. Well, good. Thank you so much for joining my show, and really look forward to. I'm certainly planning on joining the DeFi Nation myself, and I'll see you there, and we'll all have fun with money Lego.
Cool. Thanks for having me, Nico.
Absolutely. Thanks so much.